Section 3, Income and Expense Analysis, PAV, Chapter 12. Potential gross income and potential gross rent are interchangeable terms in this material. The course textbook utilizes the term potential gross income. The TDLR RPA exams use the term potential gross rent. Sources for data needed to estimate income and expenses based on market information, PAV, page 319. 1. Buyers and sellers commercial properties. 2. Commercial property managers. 3. Real estate agents, commercial appraisers, tenants, public records. C. Leases associated with income-producing properties. PAV, page 320. Number 1. Month-to-month lease. A. Short-term lease. B. May not always be in writing. C. No security for the landlord or the tenant. D. Lease can end at any time with proper notification from either landlord or tenant. 2. Short-term leases are typically less than 5 years in length. 3. Long-term leases are typically 5 years or longer in length. 4. Percentage lease. The tenant pays the property owner a percentage of income from the sale of merchandise or services.
That's what Mike had at the NFL, man.
B. Normally contains a minimum rent provision as well. C. The tenant must pay the percentage or the minimum, whichever is higher. D. The difference between the minimum rent and the percentage rent is called overage rent. 5. Graduated lease. A. Provides for a stated rent level for a specified period. B. Rent changes according to a specified schedule in future periods. C. May allow for periodic rent increases. D. More commonly used in recent years. E. May contain clauses allowing owners to pass through utility or property tax increases to the tenant. 4. Index lease. A. Provides for a rent adjustment at specific intervals. B. Adjustment based on some published indicator such as the Consumer Price Index. C. When the index goes up, the rent is adjusted upward. Number 6. I'm just realizing we went 5, 4, 6.
We did go 5, 4, 6.
So, really not sure what number we're on, but it
6.
says 6, renewal lease. A. Gives the tenant the option of extending the original lease terms for a fixed period. B. May provide for one or more extension of the original lease. C. When market conditions are changing rapidly, renewal leases can work to the tenant's or to the property owner's advantage, depending on the direction of the market. D. Rent rates upon renewal can be predetermined or negotiated at the time of renewal. 7. Triple net or net lease, PAV, page 322. A. The lessee tenant pays all expenses arising from taxes, insurance, and building maintenance as well as rent. B. The lessor, the landlord, incurs expenses only for reserves for replacing short-lived items. C. If triple net leases are prevailing standard for a property type in the market, the appraiser needs to determine what reserve expenses a prudent property manager would incur. D. The tenant assumes the contractual responsibility for paying property taxes. This does not relieve the property owner from the legal responsibility for the taxes. D. Rent associated with income-producing properties. PAV, page 322. Number 1. Contract rent. A. Rent specified by the terms of an actual lease agreement. B. May or may not reflect the current rent that could be earned by the property. 2. Excess rent. A. The difference between market rent and contract rent. B. Occurs when contract rent is higher than economic rent. C. This means that the current tenant is paying more for rent under their lease than the new tenant would pay. 3. Percentage rent. A. Used for retail properties. B. Based on fixed or graduated percentage of gross sales. C. Often combined with a stated minimum guaranteed rent, base rent. Number 4. minimum rent. A. Used for retail properties. B. Used in conjunction with percentage leases. C. Minimum rent payable regardless of the level of gross sales of the tenant. Number 5. Overage rent. Occurs with percentage leases of retail properties. The amount of rent paid over the stated minimum rent. Number 6. Market rent. A. The rent justified on the basis of an analysis of comparable rental properties. B. The rent that could be earned if the property were vacant and available for lease. C. The difference between contract rent and market rent is called deficit rent. D. Estimated by comparing the rent earned on recently leased properties that are similar to the subject property. E. Can be described as the amount a prudent landlord would charge and a prudent tenant would pay. E. Rental units of comparison. PAV, page 323. Number 1. Square foot. Gross leasable area, GLA, also known as gross building area. Net leasable area, NLA, usually the interior measurements of the space occupied by a tenant. A. Shopping centers. B. Retail stores. C. Office buildings. D. Warehouses. E. Apartments. F. Leased land. Number 2. Room. A. Apartments. B. Motels. C. Hotels. Number 3. Apartment units. Number 4. Space. Mobile home parks. B. Trailer park. C. Parking garages. Number 5. Percentage of gross business income. A. Retail stores. B. Shopping centers. C. Restaurant. D. Gas stations. Number 6. Bays. Car wash or quick lube garages.
Oh, those are rental units, right? This is the list of rental units.
Yes.
Okay.
F. Estimating effective gross income, EGI, of the subject property. PAV, page 324. Number 1. Potential gross income, PGI. The maximum possible annual rent the property could produce. B. Assumes full 100% occupancy. C. Based upon market rent at the date of the appraisal, not contract rent. D. Market rent is estimated after reviewing comparable rental properties.
Okay. Emphasize the note.
How would you have me do that?
This note is very important. He told us in the level 3, he said pay attention to the notes that are in the textbooks.
Okay. Dawn, pay attention to the note that is in the textbook. Ding, 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 ding. Asterisk, asterisk, asterisk. Hashtag, hashtag. Pounds on, pounds on.
Okay.
Bleep, 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 bleep. We are bringing you a special announcement. Texas appeals courts have ruled that the market rent is appropriate even if commercial property is subject to long-term lease at below market rates. Texas Civ App 590 SW2D793. This ruling holds even if the market rent is lower than the contract rent. For property tax purposes, market rent should be used no matter what the lease states. Bleep, 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 bleep. We now return you to your regularly scheduled program.
That's good.
Thanks. I do what I can.
Yes.
Example of estimating income. For example, if you are appraising a shopping mall containing 750,000 square feet of leasable space, the mall has space for 40 tenants, plus 2 anchor tenants. The anchors occupy 520,000 square feet. Market rent for anchor tenants in comparable malls is 0.75 cents per square foot per month.
Do you think 75 cents per square foot per month?
Huh?
It's 75 cents per
Yeah,
square foot per month.
I get it. I was just reading.
Oh, okay.
I'm not comprending.
You're not thinking?
Don't comprende.
Yeah, I need you to think just a smidge.
Don't comprende. Okay, fine. Market rent for anchor tenants in comparable malls is 75 cents per square foot per month. 10 years ago, the anchor tenants in the subject property signed 25-year leases calling for 55 cents per square foot. Market rent for the other 230,000 square feet in the mall averages out to $1.25 per month. All non-anchor tenants have short-term leases. Market rent for the anchor tenants equals 75 cents per square foot per month. You should use $1.25 per square foot per month for the non-anchors. The yearly potential gross rent PGR equals $8,130,000.
Can you read that little grid?
Do you want me to go across?
Yes, because it is.
Oh, I see.
Yeah.
Okay, so the tenant is non-anchor. There's 230,000 square feet times $1.25 equals $287,500. The anchor tenant occupies 520,000 square feet times 75 cents rent equals $390,000. Add those together and you get PGR per month.
Potential gross rent per month of $677,500. And then you multiply that by 12 per year, 12 months, equals PGR potential gross rent for the year of $8,130,000. Yeah, we're always supposed to annualize. I remember this from class. I knew it came in there somewhere.
Number 2, effective gross income, EGI. It's in PVA, page 324.
The Green Book of Vomit.
A, calculated by subtracting vacancy and collection, V&C losses from PGR. B, arises only from the primary operations of the business, rental income. C, does not include miscellaneous income. D, estimating the vacancy rate. Number 1, consider the current level of vacancy in the market. Number 2, consider the impact on vacancy of new construction in the near future. E, estimating collection loss, which is the percentage of rent earned that is not collected, tenants failed to pay. Number 1, consider collection loss rates at comparable properties. Number 2, consider the credit worthiness of the tenants in the subject property. Development of vacancy rates for apartment buildings. So, apartment building A, number of units 120, straight out of the book.
Yeah.
Less occupied units of 112 equals 8 vacant units. The vacancy loss rate is 8 divided by 120, or 6.7%. Apartment building B has 150 units less the 139 occupied units equals vacant units of 11. 11 units divided by 150 units equals a vacancy loss rate of 7.3%. Apartment building C has 160 units total less 148 occupied units equals 12 vacant units. Then the 12 divided by 160 equals a vacancy loss rate of 7.5%.
Okay.
What is this formula for? Why did they put it right here?
They're showing the first part of that long page that I just showed you.
I understand that, but we just figured out since we just figured the vacancy rate for an apartment building, we're going to pin this up here in this progression of building this equation. The potential gross rent minus the vacancy and collection rate, or losses, which equal the effective gross rent. Your PGR is given by your owner or stated by the market, and the vacancy and collection rate must be computed by the assessor. How'd I do?
Market, really. And your effective gross rent. So PGR minus vacancy and collection loss equals your effective gross rent.
I said that.
I know. I'm just repeating it.
Number 3. Miscellaneous income. Income generated from sources other than rent on a property. B. Also referred to as secondary income or service income. C. Examples include income from 1. Parking revenue, 2. Resale of utilities, gas, water, electricity. 3. Coin-operated laundry and vending machines. 4. Club room rent. 5. Internet service. D. Market analysis may reveal that miscellaneous income consistently equals a predictable percentage of effective gross rent. E. In such cases, you first calculate the property's EGR and then use that percentage to estimate the miscellaneous income. F. For mass appraisal, miscellaneous income can be estimated as a percentage of a property's EGR. Number 4. Effective gross income. EGI. A. Adding miscellaneous income to EGR gives you EGI. Expenses required maintaining the miscellaneous income stream should be subtracted so that only net miscellaneous income is included. C. Vacancy and collection losses do not normally apply to miscellaneous income. D. Owners' operating statements often do not distinguish between miscellaneous income and income from primary operations. Even a business as apparently simple as an apartment complex can generate miscellaneous income from a surprising number of sources.
You can just read that formula straight.
The formula thus far is PGR less VNC losses equals EGR plus miscellaneous income.
And you get EGI.
And that equals EGI. They should have told us that.
They should have. Effective gross income.
Example of analyzing an operating statement. The following chart shows some figures on an operating statement.
You're not going to.
Each income category marked by an asterisk falls under the general heading of miscellaneous income. Interest and miscellaneous income present special problems. The income estimate should only include revenues attributable to operating of the property. If interest income does not arise from property operations, it is not included in the income estimate. If interest arose from the tenant's security deposits, it is included as a miscellaneous income. Miscellaneous income must be scrutinized to determine whether it is attributable to the property. Note that PGR and EGR do not appear on the owner's statement. The $883,554.75 labeled rental income exceeds the total income because on this statement it equals the amount the owner would have received if he or she been able to charge and collect the posted contract rents. To attract tenants, the owner offered discounts at approximately 10%, creating a loss of $83,275.66. Nonetheless, actual rental income does not equal PGR. Actual rental income does not necessarily assume 100% occupancy. PGR does. You cannot determine the percentage of total units occupied from this statement. PGR assumes market rents. The use of a 10% discount suggests that posted contract rents for this property exceed market rents. The point of this example is simple. When you receive an operating statement, PGR and EGR must be reconstructed using prevailing market rents and prevailing VNC losses. You should then examine the miscellaneous income shown on the owner's statement to determine how much it arises from the property. Add that amount to the EGR to get the EGI. Do not apply VNC loss to miscellaneous income.
That comes in before the step. Okay.
G. Estimating operating expenses and reserves for replacement. PAV, page 326. Number 1. Operating expenses are ordinary and typical expenses that are necessary to keep the property functional and rented competitively with other properties in the market. Number 2. Only reasonable and typical expenses needed to maintain the income-producing capacity of the property should be allowed. Number 3. Expenses that are expected to occur each year must be identified. Number 4. Appraiser must review the owner's operating statements. Number 5. Proper allowed expenses considered in estimating operating expenses. A. Management fees, often expressed as a percentage of EGI. B. Salaries and fringe benefits for employees needed to keep the property competitive. C. Utilities that are typically paid by the property owners in the local market. D. Supplies and materials. E. Repairs and maintenance for normal wear generated from the use of the property. F. Property taxes in an ad valorem appraisal are usually not deducted from operating expenses, but considered in developing the overall capitalization rate, the OAR. G. Property insurance premium. H. Miscellaneous expenses only that are recurring and necessary. I. Reserves for replacement.
That's the list of proper allowed expenses.
Number 6. Reserves for replacement include annual charges for items that have fast depreciation and must be replaced before the end of the property's useful life. A. Items that may require reserves for replacement. Number 1, roof cover. Number 2, water heaters. Number 3, heating and air conditioning. Number 4, floor covering. Number 5, elevators. Number 6, kitchen appliances. Number 7, furniture in furnished apartments and lodging. B. Calculating reserves for replacement for appropriate items. Number 1, estimate the useful life of each item. Number 2, estimate the replacement cost new, the RCN, of each item. Number 3, calculate the annual percentage of reserve, straight line method, by dividing 100% by the useful life of the item. Number 4, multiply the RCN by the annual percentage of reserve. Example of estimating replacement reserves. To estimate replacement reserves, appraisers usually determine the useful life of a property component and its typical cost. Dividing the cost by the life gives the reserve for each year. For example, a roof might cost $15,000 and last 15 years. The reserve for replacing the roof would equal $1,000 per year. Carpets might cost $20,000 and last 10 years. The reserve for the carpet would be $2,000. This process resembles the age-life method of calculating depreciation used in the cost approach to value. What?
They mentioned depreciation.
Yeah, but that's not one of them big ugly words.
Okay.
RCN divided by estimated life equals annual reserve for replacement. Number 7. Improper disallowed expenses. Those expenses found on an operating statement which are never allowed for appraisal purposes. PAV, page 330. A. Depreciation. Accounting depreciation, not physical depreciation. B. Debt service, including principal and interest on any mortgages. C. Income taxes paid by the owner. D. Capital expenditures accounted for in the capitalization cap rate. E. Business expenses of the owner. F. Repairs for unusual and unanticipated expenses. Flood damage, for example. If the property requires repairs, the appraiser should consider adjusting the value estimate. H. Calculate net operating income, NOI, PAV, page 335. Number 1. The direct capitalization method requires you to use the subject's property NOI. NOI is calculated by subtracting the following expenses from effective gross income, EGI. Number 3. NOI is the amount of yearly income the property would typically generate under prudent management, independent of any unique investment strategy or leasing practice. Number 4. NOI is not necessarily equal to the operating income shown on the property's operating statement. Number 5. In order to calculate NOI, you must already know PGR, VNC losses, net miscellaneous income, and allowable expenses. Number 6. For ad valorem taxation in Texas, the appraisal date is January 1. Income expenses analysis should determine the NOI a property owner would typically anticipate receiving in the year beginning on that date. Number 7. Income and expenses are often verified by rent rolls supplied by the owner, which show the names of tenants, amount of space leased, and the terms of their leases. We're going to unpin our equation and add to it. PGR less V&C losses equals EGR plus net miscellaneous income equals EGI less allowed expenses including reserves equals NOI. Repin. Example of estimating income, expenses, and net operating income, NOI. Figure 3.4 on page 30 shows a reconstructed operating statement derived from Figure 3.3 on page 29. It begins with the calculation of PGR from market rents. The V&C loss is derived from the market. V&C is subtracted from the potential gross rent, yielding the EGI. Allowed expenses are derived from the operating statement, Figure 3.3 on page 29, and subdivided into 3 main categories. Debt service and depreciation are disallowed. Repairs are also disallowed. The repair expense is covered by the reserve for replacement. The reserves for replacement are calculated by estimating the actual cost of each component and dividing it by the useful life of the component. In this case, we have assumed that the repair of low-cost items, light fixtures for example, are covered by the miscellaneous category under the variable expenses. Payroll taxes on employee salaries are allowed. Management is 4% of EGI on primary operations. This percentage is derived from the market. In other cases, the percentage for management may apply to miscellaneous income. Market analysis should tell the appraiser whether to include miscellaneous income in the amount from which they calculate management. In the example, NOI is $75,292. Figure 3.1. Income analysis levels of real estate income. Income calculation process, PGI, less V&C allowance, plus miscellaneous income equals EGI, less operating expenses allowable equals NOI, less debt service, mortgage principal, and mortgage interest equals before tax cash flow, which is the equity dividend and cash throw-off, less income tax liability equals after tax cash flow net return. Income analysis levels of real estate income. Income calculation process. PGI less V&C loss equals EGR plus miscellaneous income equals EGI less operating expenses, allowed expenses reserved for replacement, equals NOI, less debt service, mortgage income, principal, and interest on mortgage, equals equity dividend, equity income, cash flow. Do you want me to read the sample operating statement?
No, because you really got to be looking at it to...
Yes, you do. Do you want me to read the reconstructed operating statement?
And I think we've referred to that already. We're getting there, honey.
Example of estimating income, expenses, and net operating income, NOI. The operating statement on figure 3.5 on page 32 shows actual income and expenses in column 1, budgeted income and expenses in column N2, and the difference under variance. For income, the variance is the actual cost minus the budgeted amount. For expenses, variance equals the budgeted amount minus the actual cost. dollar per square foot shows the expense or income per square foot. Owner's estimate of NOI follows the operating expenses. For appraisal purposes, the non-operating expenses, everything below NOI, are disallowed. Non-operating expenses. The PAV discusses capital expenditures and debt service, interest, and principal. Build-out is a special type of capital expenditure. It covers the cost of making space ready for actual tenants, moving walls, doors, or windows, providing special electrical or computer lines, or installing other special equipment. Leasing commissions may appear in the operating or non-operating expenses. Generally, when a property is first rented, the leasing commissions exceed those required to maintain normal occupancy. These initial leasing expenses may be recaptured over the property's life. In such cases, initial leasing commissions would be disallowed as capital expenditures. The operating statement is for a new building and handles leasing commissions in this fashion. Operating expenses. Most of these would be allowed if they reflected typical costs. Repair expenses have to be checked carefully. Most operating budgets include year-to-date figures shown here and current month expenditures. You can often compare the monthly number to the year-to-date number to determine if an expenditure represents a reserve for replacement. If repairs reflected a normal reserve amount, you would allow them. If they did not, the property owner would have to show that no reserve covered the expense and that maintaining the property's income stream required it. You would need more information about building repairs, professional services, miscellaneous, travel reimbursement, and reimbursable expenses to determine if these expenses would be allowed. Minor costs for such things, such as repairing sheetrock or broken windows, would be allowed. Charges for long-term depreciation of the structure itself would be covered by recapture and disallowed. Reasonable costs for professional services, legal and accounting, for example, would be allowed. They would not be allowed if the cost seemed excessive or the service unnecessary. The same general rule, necessary to prudent operation at a typical cost, would determine whether miscellaneous expenses, travel reimbursement, and reimbursable expenses were allowed.
No, we're not reading that.
Holy moly, that's insane.
That it wouldn't surprise me if something like that shows up on a test.
And them ask you these grade-in areas to figure out.
Maybe. Well, those grade-in areas are summary. Yeah. Mm-hmm.
That makes me want to poke my eyeballs out.
Yes.
Just saying. Okay, this is letter I. Using an expense ratio to convert gross annual income to NOI, PAV, page 335. Number 1. In some cases, appraisers may subtract expenses by using an expense ratio. Number 2. An expense ratio can be a percentage of PGI or EGI, but is typically a percentage of EGI. Number 3. It reflects the allowed expense that properties of a given type usually incur. Number 4. The expense ratio may apply to miscellaneous income. Number 5. It should cover all allowed expenses. Number 6. In some cases, the ratio may not reflect property tax expense when using an effective tax as a component of the OAR loaded cap rate. Number 7. Expense ratios provide a useful way to check the expenses derived from operating statements and knowledge of the local market. Number 8. Expense ratios generally reflect national averages, but expenses can vary widely from state to state and from one location in the state to another. Number 9. When they use expense ratios derived from national sources, appraisers should adjust them to reflect local market conditions. Number 10. Properly adjusted to the local market, these ratios can become an important time-saving step in a mass appraisal system. Number 11. Factors that can affect operating ratios. Number 1. Terms of existing leases. Number 2. Type of property. 3, aging condition of the property. Number 4, type of tenants. Number 5, quality of property management. Number 6, geographical area. Calculating the expense ratio.
I don't know how to read it, unless it's total expense.
Total expense dollars is equal. Nope.
It's not equal. I don't know.
Well, let's see what we come up with in the reading. High-rise apartment expenses might typically run 40 to 45% of the effective gross, or 30 to 35% of the potential gross. Office buildings might run 35 to 45% of the effective gross, or 30 to 40% of the potential gross. An appraiser using an expense ratio should first calculate the appropriate gross income, potential or effective. Then multiply the percentage times the gross to get the allowed expenses. Subtracting the allowed expenses would give the NOI. Appraisal districts may also find that variance of an expense ratio more accurately reflects anticipated income streams and expenses in their markets. Some appraisal districts, for example, have found that tables showing the typical expenses per square foot for income-producing properties of various classes yield more accurate estimates of NOI. For example, Class A mall stores might show expenses per square foot of 31 cents. If the typical Class A mall store produced effective gross income of 78 cents per square foot, then NOI per square foot would equal 47 cents. The 78 cents minus the 31 cents. The expense ratio would equal 40% rounded. 31 cents divided by 78 cents equals 39.7% or 40% rounded. Does that help?
Sure. Well, it doesn't help figure out what that thing is on top.
Well, it's your total expense divided by your effective gross income per square foot. In this example, it's the mall stores show expenses per square foot. It's expenses per square foot of 31 cents divided by your 78 cents effective gross income.
Oh, they just made that. They just made that kind of retarded.
Yes, they did.
Oh, okay.
They were trying to be slick and they sucked.
Yeah, okay, so that's what that's about.
Anyways, the last thing is the Irv triangle, and I don't know how to read this.
Well, the answer is the completed box, and the empty boxes is you have to fill in the missing factor. So I divided by R equals V. So we have, you can take I divided by value. If you have those two factors, you can get your rate, your missing rate. I divided by R, get your missing factor, value. And then rate times V. If you have those two factors, your income, you get your income.
Okay.